Good afternoon, everyone. If you are on the West Coast, it's still morning, so good morning to you. Thank you for joining us for our first session of GovCon updates. We have two expert instructors joining us from Dentons. That's Natalie and Morgan. I'd like to thank them for being here today. If this is your first session with us this year, Happy New Year. Before I do pass it off to our instructors, I'm going to go over some quick housekeeping announcements. We're going to have a couple of passwords today. When those passwords pop up, please just make sure you write them down. That will be how you receive your credit for attending today's session. We also have a question section. If you have any questions for the instructors, you can ask it there, and they'll be able to address it for you throughout the session. If you notice any audio-visual issues, anything like that, I'll be able to address that for you there as well. If you have any questions about passwords or certificates, you can ask them there, but you can also email me at joshpina@publiccontractinstitute.com. Finally, if you have not had a chance to download a PDF version of the slide deck you'll see our instructors going through today, you can click on that materials tab and download it to follow along. So without further ado, I'm going to pass it off to Natalie. Thank you.
All right, thanks, Joshua. Good afternoon, everyone, and thanks very much for joining us for today's session. This is our quarterly legislative and regulatory updates. My name is Natalie Seelig. I'm an associate here at Dentons in the Government Contracts Group, and I'm joined by my colleague Morgan Murphy. She's also an associate in the Government Contracts Group, and we'll be walking you through some updates today. So you can advance to the next slide, please. All right, on the agenda, if you followed us for some of our previous quarterly updates, we usually do kind of a high-level overview of everything new. But following our previous update from December, we decided for this session, it makes sense to just focus on 3 significant changes and really get into the details of them. So for the regulatory updates, we're focusing on the SBA final rule. This is updating HubZone and other small business programs. So we'll start with an overview of that program and then move on to updates to the 8A program, changes to HubZone definitions and certification rules, certifications and standardization to affiliation rules for small businesses, and new impacts on the eligibility after disqualifying free certifications, and some new protest provisions. And then separately, we're also going to be covering some new monthly reporting requirements from the OFCCP that was newly announced at the end of last year and will be implemented in April. And for legislative updates today, Morgan will be covering the NDAA. So she's going to focus on acquisition policy matters, domestic preference and critical materials, national security related matters, industrial base and small business matters, and then finally some cyber related matters. So you can advance to the next, please. Great, so we'll start off here with the SBA. Just to give some overview, we'll start here on December 17th, SBA issued this new rule. The FedReg site is on the slide here. It's 89 FedReg 102.448. Since our presentation will only be covering, some of the most significant changes in this rule, we of course also advise that everyone read the full text at that site because of course this rule really changes a lot. It's super long. So it actually takes effect today. It implements some changes to the 8A program, changes to definitions affecting eligibility requirements, updates to recert requirements, and updates to affiliation standards. So starting off with the 8A program, 2 kind of key changes here are updates to the rules around non-8A business activity targets and changes to requirements for financial statements. So for 8A participants, each year they must hit a certain target for non-8A revenue. And this is really to ensure that once they graduate from that program, they're actually competitive, they're actually getting business. The SBA really just wants to make sure that they're not wholly dependent on just 8A work. And each year that target increases, right? So the threshold is going to go up for each transitional period each year. In the past, there used to be pretty severe consequences for not hitting those targets, and companies wouldn't be eligible for 8A sole source awards until they hit it. But the SBA had changed those restrictions a few years back, and now if participants don't hit the target, they can still be eligible for those awards as long as they can demonstrate a, quote, good faith effort to obtain non-8A work. So they had previously clarified that this can be demonstrated through providing unsuccessful bids, like the literal proposals that they submit, just to show, we're still trying to get some of this 8A work, even if we were unsuccessful. And the agency had said, we'll consider that and we'll count that towards your target, even though you didn't quite hit it. So with this new rule, the SBA is trying to kind of clarify what they mean by that. What will they actually consider and what won't they? And these kind of new provisions add some restrictions. So now it will only consider the base year of the procurement at issue for whatever the unsuccessful bid was, and not the projected full value of the procurement. And the SBA will also not consider any projected revenue if you bid on something that you really didn't have a reasonable prospect of success for. So if you know you're not eligible for a bid, if you know you can't meet the stated requirements, you can't provide that service, they won't take that into consideration for your revenue targets. What this signals is really just like an increased monitoring of the compliance with these targets. And 8A participants really should consider this if they're, close to meeting their targets, or if they are anywhere at risk of not kind of hitting it for the year. And the second change here on the slide, and I apologize, I have a cough, so sorry that I keep interrupting. But the second change here, we've got some changes to financial statements. So they increased the threshold for participants to be required to submit reviewed or audited financial statements. The rules make it so that only 8A participants with gross annual receipts of more than $20 million have to submit audited annual financial statements, which are prepared by licensed independent public accountants. And that is an increase from previously $10 million threshold. And then similarly, only those participants with gross annual receipts of above 7.5 million are now prohibited from submitting in-house financial statements. So not audited, not reviewed. Now, obviously, you can be a lot bigger and still be able to submit these in-house financial statements. So this change should really just make it less costly for small businesses and allow participants of this program to meet these reporting obligations, in an easier and cheaper way if that's something that they choose to do. If they do have the capability to do it in-house, now they can. You can advance to the next slide, please. So the next update that we're discussing is the final rules updates to HubZone programs definitions. The first two key changes are the definition of principal office and the definition of employee. So principal office means the location where the greatest number of the business's employees at any one location perform their work. And kind of the change here, the new requirement, now for leases of principal offices, companies have to lease starting at 30 days before the date of the SBA review and at least 60 days after the date of SBA review. It also states that firms might be required to prove that it's actually conducting businesses at this location. So it has said now in the new regulations, it may require photos of the dedicated workspace. It may require you to provide a virtual or a live walkthrough. And it also, the rule kind of goes into this explanation that it considered in the proposed rule to allow for virtual offices, but it did not adopt this kind of like telework virtual office concept from the proposed rule because it received so many negative comments on it. So in the proposed version, they would have allowed virtual offices if at least 51% of the employees resided in the hub zone. Because that did not get adopted, you still now need to have a principal office in a hub zone, and at least 35% of the employees need to reside in that hub zone. And then the kind of second key definitional change is to hub zone employee. So in the proposed version of this rule, which I don't think I mentioned, but it was issued back in November of last year, I think they received over 700 comments on it. So there was some pretty good back and forth within the rule of the SBA really considering them and making some changes to them. So that's good. But in the proposed version of this rule, the SBA had said that they're considering adopting an 80-hour per month requirement. So raising it from a 40-hour per month in order for employees to be considered hub zone employees. But they didn't go forward with this because there was too much pushback and negative comments on this. Now you still have to work the 40 hours per month to be an employee, and you also must work at least 10 hours per week. So they basically just don't want you to work your 40 hours in 1 week of the month and then be off for the rest of the month. They say that you can provide a legitimate business reason for not complying with this, as long as you kind of meet that 40 hours. So like I just said, if you, for example, have a legitimate business reason to only work that first week of the month and then not the following 3 weeks, you can still be compliant, but by and large, you have to have your employees, routinely working those minimum 10-hour weeks. Then that isn't counting sick leave or, parental leave or anything like that. So barring that, it's really just that 10-hour per week requirement. So this is kind of like they didn't increase it to the 80 hours that they said they would, but this provides them at least with some, increased restriction. They also add a new provision that states it may require evidence that an individual is actually performing work. So it may ask for things like a job description, the individual's resume, some form of work product or deliverable report to just show, yes, this person is actually working for me. Here's what they do here. All right, you can advance to the next slide, please. So the next topic is changes to hub zone certification and employee requirements. With this final rule, the SBA changed the definition of reside for hub zone purposes to require that the individual live at that address only for 90 days. So it used to be 180 days. So this will hopefully make it easier. In their kind of explanation portion of the rule, they explained that really not concerned that this period would be so short that they might see companies, trying to hire employees only for that period and then get rid of them, because they now have this new reporting requirement that we'll discuss later, where you need to be eligible at the date you submit your offer. So because of that kind of allows them to shorten this and shorten the period and not worry about, the companies that might try to be eligible just that once per year by hiring someone for the 90 days and then getting rid of them. So that's good. That's a good change. Will hopefully make it easier. It also kind of discusses some additional flexibility in response to some comments saying that you should be allowed to prove residency with something other than a driver's license. So kind of a technical change, but now in addition to driver's license, they can consider other, bills that come to your utility bills or leasing agreements or whatever. So that will be hopefully add some more flexibility and signal some more flexibility there. The next kind of change here is changes to legacy employees. So a legacy employee is an employee that used to live in a hub zone and then moves, or the area where they live is no longer covered by like the hub zone border. And SBA allows them generally to still count as a hub zone resident employee if they continue to live in that hub zone 180 days after the cert or recert date. but now adds some restrictions. So in the proposed rule, the SBA was considering getting rid of allowing 4 legacy employees to count as HubZone residents and limiting it only to 1 resident employee, singular. But it received a bunch of negative comments on this as well. And apparently this would have had a pretty major effect on, currently eligible HubZone participants. So they kind of took a middle ground here. And companies now are still allowed to have up to 4 legacy employees count as their HubZone resident, but the legacy employee can't work less than 30 hours a week and can't have initially qualified by these kind of special designations of redesignated area or qualified disaster area. So some kind of new restrictions there that companies need to be cognizant of, but not as restrictive as the proposed rule first kind of contemplated. So that's good. Getting now into the certification requirements, the rule eliminates the 1-year cert rule, which previously allowed firms, as I kind of signaled before, to only be eligible on the date of their cert, right, or the date of their cert anniversary. And then even if they lost eligibility, that wouldn't matter, right, because it was just that 1 day per year. Now companies have to be eligible on the day they submit an offer for any HubZone contract, and they're only required to certify it every 3 years. So again, this is kind of like taking a middle road, because initially, before, companies had to be eligible on the date of offer and award, which that led to some confusion and uncertainty. Obviously, sometimes you submit an offer and you don't get an award until years later. Usually it's not that delayed, but you encounter situations where that could be uncertain. It's not the best rule. Then they changed it to that once a year cert rule, and really that was their thinking too lenient. So here we're seeing them tighten up, kind of take that middle ground. And what this means is that you have to now be mindful that on the day you're submitting your bid, you are complying with all the HubZone requirements. So you need to have the HubZone employees living in the HubZone. You need to make sure you're meeting that on the day you're actually submitting the bid, which will end up being a pretty big change, right? So before you could just do it once a year, and now you have to make sure at the time you're submitting your offer. You can advance to the next, please. Sorry, there's a slight delay. But the next update we're going to be discussing is updates to permitted negative controls. This is an important change. It'll impact how the SBA determines whether a company is an affiliate for purposes of measuring the business's size. So it's really important for minority shareholders, and whether or not they have an ability to exert control to protect their investments without kind of impacting whether a small business can still be eligible to qualify as a small business. Because if they have too much power, then that shareholder is going to be considered an affiliate and they'll be counted together. So, just to give some background, in order to determine if a business qualifies as a small business, the SBA looks to the business concern and all of its affiliates, and they look, to whether they're under common control. So if one controls the other or has, quote, the power to control the other, that is kind of the standard and test for whether or not it'll be an affiliate. And previously, before this change, even the regulations have already contemplated that control can be either negative or affirmative. And negative control includes when minority shareholders have the ability under the concern's charter or its bylaws or its shareholder agreements to prevent a quorum or otherwise block action by the board of directors or shareholders. So that kind of requirement was already in the regs. And generally, any of these negative controls would count as a control, right, under the regs of of what counts for affiliation. And therefore, it would make the minority shareholder count as an affiliate. Obviously, that would impact or could impact the business's ability to maintain its small status. And previously, with this in the regulations, case law had created some exceptions to those minority controls, but they weren't consistently written or enumerated within these affiliation kind of standard regulations. So you'd have to really look previously to the case law, which there was a pretty dominant rule that prevailed with OHA, and I forget the other body that really issues the case law, but OHA, there was a bunch of case law that really made a relatively consistent rule, but again, it was a fact by fact determination, and it wasn't codified in the regulations. So with this rule, it's kind of looking to that general rule from case law and from certain socioeconomic regs definitions, and taking some specific 7 enumerated exceptions of when minority shareholders' negative controls will create affiliation and when they won't. So this is significant because for certain affiliation regulations under certain socioeconomic programs, pretty much any degree of minority shareholder control created affiliation. So it meant that small businesses were super restricted in having minority shareholders have a say in any kind of significant or long-term business decision. And even for the affiliate standards that did kind of get interpreted to include these exceptions, it was obviously not consistent. It wasn't super clear. So this rule is, trying to streamline it, trying to make it clarified, and trying to make them apply across all of the socioeconomic affiliate standards. You can move to the next slide, please.
Really quick, Susan, you had your hand up. I don't know if there's a way that we can get you to kind of give you an ability to talk. I don't know if anybody can help who's on the line with PCI, but Susan, did you have a question?
I can try to unmute her now if she does still have a question. In the meantime, I can put up the first password. Which Susan was it? We have a couple of Susans.
It flashed up really quick, so it may just be easier
if you... I saw it flash too, but couldn't see anything further.
It might be easier if it's in the question box, maybe.
Okay, Susan, whichever Susan it was, if you want to message us in the chat, and then we can unmute you so that you can get your question out verbally, or if it's just easier at this point just to message it in the chat, that's fine too. I do have our first, and that first password is the word first. So capital FIRST is your first password today. Please make sure you're writing down these passwords because that will be how you receive credit for attending today's session. I'm going to take this down now and back to you.
Okay, great. Sorry, if you could advance to the next slide. I don't know if you already did. There's a bit of a delay. Perfect. So to continue our conversation or discussion about permitted negative controls, this is the text now of what the new rule looks like. And again, this is across all affiliate standards. So for all small businesses or socioeconomic programs, this is what will apply now. So it now says SBA will not find that a minority shareholder has negative control where such minority shareholder has the authority to block action by the board of directors or shareholders regarding the following extraordinary circumstances. So these are the 7 kind of exceptions that are extraordinary circumstances. including adding a new equity stakeholder or increasing investment amount of an equity stakeholder, dissolution of the company, sale of the company, merger of the company, company declaring bankruptcy, amendment of the governance documents, and then kind of significantly, this one did not exist even in the, I think it's the service disabled veterans small businesses that did have most of these enumerated already, but they didn't have this seventh one, and this was in response specifically in the proposed rule. A bunch of commenters were like, this is really still pretty restrictive, and we'd like to see some type of catch-all. So they add this seventh one that says any other extraordinary action that is crafted solely to protect the investment of minority shareholders and does not impede the majority's ability to control the concern's operations or to conduct the concern's business as it chooses. So hopefully this adds some flexibility. Again, minority shareholders, to a certain extent, will be able to now exert some control without affecting the affiliate status. And I guess to give some tangible examples, this means if minority shareholders can have negative control over things like compensation, who the company is hiring, budget, that would probably mean you have negative control over the ability of the majority's conducting like day-to-day business, conducting business. So that would get you in the realm of you are an affiliate, right? That's too much power. In contrast, if they simply have the ability to block actions like governing documents, bigger things like changing the size of the board, that is permissible, and that's not going to impact affiliation. So this will be good. It's expected to increase investments into small businesses. Now, investors don't need to worry as much about protecting their investments, and they'll have, some say in these long-term kind of bigger decisions without kind of affecting the affiliation status. If you could advance to the next slide, please. All right, so I think this is the final slide on the SBA update. It's discussing size and status recertification, and then some related changes to protests. So as I think I previously mentioned, size and status is generally determined when you submit your bid, right, on the date of offer. But you also have to recertify within 30 days of certain like triggering transactions. These include mergers, acquisitions, and sales, which result in some type of change in controlling interest. So think about mergers and acquisitions if one company buys another. So after certain events, these companies will need to recertify. And a recertification can either be what the regulations call a qualifying recertification or a disqualifying recertification. I don't know why I'm struggling to say that word. A disqualifying certification is where the transaction results in the firm now not being small. They're other than small after the transaction. So it's bought by another firm, for example, and as a result, they're no longer small. They don't meet the standards. But a qualifying recertification is where the transaction occurs and the firm is still small, has no impact. So under this new rule, the kind of change here is that for disqualifying recertifications, you'll now be ineligible for future task orders on small business multiple award contracts. So, relatively limited, but it's still going to be a significant change. Before you were eligible for those, and the agency just couldn't take couldn't take credit for your status. And just to note, this is not applicable to single awards. So if you're looking at a single award contract, you have a future task order you're looking at, that's fine, you're still eligible for those. It's affecting multiple award contracts only. And then relatedly, in order to kind of enforce this and to give, or they make a new protest provision, which didn't exist before. And now any contract holder on that multiple award contract, so it does have to be someone on that same contract vehicle, can file a size protest challenging the recert. So big update, obviously, for anyone looking to protest an award, and will probably generate some new types of protests. You can advance to the next, please. So next we're covering updates to the Office of Federal Contract Compliance Programs, OFCCP. It's a new monthly reporting requirement. The OFCCP recently announced that it's reinstating this requirement. It actually hasn't been used since the 90s. It's called the CC 257 report. It's going to be applicable to all federal construction contractors or subcontractors with a contractor subcontract exceeding a value of $10,000. So pretty significant for contractors conducting construction work. And the requirements of this form are straightforward. And there is a form online that businesses can fill out with all the required fields. While it's not difficult to figure out what they want, it's possible this can be pretty burdensome, because what it's asking is for contractors to submit information about employees' work hours each month, split out by classification, so whether they're an apprentice or trainee or foreman or whatever, and by race and gender. And you also have to submit it kind of separated out by covered areas, which is geographical areas defined in the regs. So what that means is, a really important part of this is you need to look to see if your record keeping system or your timekeeping system is separated out by these classifications, and also that for each project in each covered area, that's going to be a requirement. Obviously, this is going to be pretty difficult to comply with if your current record keeping system doesn't look into any of this, doesn't already track it. But most commenters are predicting that the new administration will view this really as a DEI requirement or DEI directive. And, it's unlikely that this will survive, I'd say. But either way, it's the first reporting requirement starts in March, because the deadline for the first report is April 2025. So up and until it's unclear how quickly they'll repeal it, assuming that they do. So contractors really should keep this in mind. It was announced in April, it was announced in November of last year, but again, won't apply until April is the deadline, but the reporting period starts in March. So this could be, kind of a big change for some contractors. So keep an eye out for developments on this. And I believe that is the last slide. So I'll turn it over here to Morgan.
Hey everyone, so we're going to move into the exciting world of legislation. Specifically today, we are focusing on the 2025 NDAA. And so just going to provide some background to kind of level set for folks and give them an idea of what space we're working in. And I also think it's helpful to understand what the NDAA is, so that there's understanding, and there's an example of this later, where the NDAA ends up ultimately being more of a policy type piece of legislation. And ultimately, some of the priorities that are discussed in the NDAA do not get appropriations put towards them, so they're not ultimately funded. And so we'll talk a little bit about what the consequences of that can look like with an example from this NDAA. So starting off, this is appropriations for DoD, nuclear weapons, and some other defense-related programs. So occasionally you'll see differences between top-line spending and other elements. So if you're seeing that, that's kind of where that's coming from. It is a policy-based piece of legislation, and importantly, as I had mentioned, it's not providing budget authority. So there's no actual allocation of funds that go along with these priorities. This is the 64th consecutive version of the document, so one of the most consistent pieces of legislation that we do get out of DC. And as I mentioned, currently we are operating under a continuing resolution. So that, as a general rule of thumb, means that funding from previous year appropriations are carried forward until a set date, with the exception that most of these continuing resolutions will appropriate funds towards programs that would otherwise be expiring. Non-defense related, the example that I think of is something like the Children's Health Improvement Program. It's called CHIP, and I might be getting the acronym wrong, but it is CHIP. CHIP is one where often you'll see kind of a reauthorization of funds, in addition to the fact that you'll actually see funding just kind of continued on with a continuing resolution. So that's going to be in March, I believe, is when we're going to actually see the funds being appropriated. So interesting that we have a piece of authorizing legislation from a different administration, followed up by a bit of funding that's going to be handled by the next administration. Vicky, I hope the thumbs down is not at me. Continuing on. So this is HR 5009. So this is the fiscal year 25 NDAA, and I put the full title here in case you are going to look at it. The full title of the legislation is not the National Defense Authorization Act. It has kind of this funny whole little thing. And you'll notice, again, I want to point out it's confusing because it says to authorize appropriations. Just a really good reminder that most legislation that comes out of Congress is called authorizing legislation. There is separate legislation, which is what you often hear about in the news, which is the actual appropriations bills, and they are totally separate, and the appropriations legislation is required to actually put those kind of policies and authorized policies into effect. So the top line on this piece of legislation is $895.2 billion for DoD and DOE national security programs. It's an increase of $9 billion over the prior year. And we're going through, as Natalie previously mentioned, policy matters, domestic preferences, national security, industrial base, cyber. I will note that some of this we're going to just kind of be glossing over. I have it in the slides because it may be helpful for reference for you. We could never cover the entire bill in the allotted time because it is a 794, almost 800-page document, not counting all of the cross-references. Sorry, Vicky, I see your question. I'm a little bit late to it. NDAA is National Defense Authorization Act. Have to be better at giving acronyms because the government is fond of acronyms, and when you use them a lot, you forget that. So continuing on, we're starting with, one thing I want to cover is where we're actually having, one moment, I'm going to go to what some of the changes actually were in the amount of, we'll start with acquisition policy matters. There we go. Okay, so starting with acquisition policy matters here, we have section 802. So this is going to be amending 10 USC 3322, and it relates to allowing only one low rate initial production LRIP lot for fixed price type contracts on a contract. This is dealing with major systems development contracts. So essentially, we're just going to see less of these LRIPs allowed into the fixed price contracts for major systems developments. I don't think that's going to touch on a lot of people here, but these are just some kind of highlighted areas that might be helpful for folks. We also have section 803. So that's also going to clarify the Department of Defense contracting officers' unilateral definization, that it is in fact a final decision that may be appealed. There's often a lot of conflict you see in the case law about what a final decision actually is that then allows you to appeal it. So this is just kind of expanding and providing a little bit of clarity on what that final decision actually looks like. So if you are someone who operates in this space and you are seeking to recover funds under a contract, this may be relevant to you, and making sure that you are knowing kind of the full scope of what you have available as kind of what constitutes a final decision. We have Section 824 as well. So Section 824. Oh, and let me see. Actually, I might want to mention one other thing about Section 802. No, I think we've covered everything. Okay. So we have Section 824, which is going to amend Section 822 of the Fiscal Year 2023 NDAA. And that had previously allowed contractors and subcontractors impacted by inflation to file claims for relief. And ultimately what happened is, what it clarified that DoD could use appropriated funds to pay for claims. What I want to note here, and this is what I talked about where we have kind of differences between authorization and appropriations. Section 824 is amending a prior section, and it also appears in another NDAA version. So this is now, I think, the third iteration we see of this section included in the National Defense Authorization Act. And the prior two did not receive express appropriations in the legislation that ultimately came through to fund them. And so why that becomes a problem for contractors is that you have a policy that tells you on the one hand that you may recover costs potentially related to inflation. Again, very high level explanation of what the language says, but essentially that's what contractors have previously tried to do under this section of the NDAA. Ultimately, what we have seen is that contracting officers in the government in general have then come back and replied to contractors that, well, yes, the NDAA does in fact say that you may recover for inflation-related costs, but it is only if there are appropriations available, at which point they indicate that there are no appropriations available, leaving folks essentially empty-handed with those requests. And so this is where kind of having that understanding of the difference between authorizing legislation versus appropriations is really helpful, because if you have a policy in the NDAA but ultimately are unable to recover on it because there aren't appropriations available, it is not a particularly helpful remedy to have available to you. And so flagging this one, because we are currently operating under a continuing resolution, as I previously mentioned. And so there is some opportunity here to kind of be watching what's going on and seeing if ultimately appropriations are provided for this section of the NDAA and the upcoming legislation that Congress ultimately agrees on to appropriate funds for these policies. And so we'll certainly be watching closely to see if ultimately funds are finally appropriated for this, essentially this inflation relief that is supposed to be available to contractors. So this is a really interesting one to watch, and there are numerous cases that we've seen, and I think that are publicly available as well, kind of talking about situations in which folks were unable to recover funds for this inflation-related relief. There is also Section 881, and that's requiring an amendment to FAR 9.503 to require that all requests related to an organizational conflict of interest waiver, also known as OCI, include a written justification and to prohibit delegation of OCI waiver authority below the level of deputy agency head. And so this one's kind of interesting because the Biden administration had actually opposed this provision in its statement of administrative policy. And it was in response to the House-passed version of this, and it ultimately did get included. So just kind of a curious thing to see the different iterations of the NDAA that end up coming out, whether it's the president's original plan that he puts forth, or she. If you end up seeing it in the House version, which you'll see the House Armed Services Committee is the one that puts forth the House version of the legislation, or if it's something from the Senate version, which comes out of the Senate Armed Services Committee. House version is, or the House committee is HASC, the Senate committee is SASC. And ultimately the NDAA we often end up with is a compromise version where both committees go forth and kind of have conversations. And I just point this out because I think it is helpful to know that as you start seeing, as we go into the next year and we start to see kind of movement on some of these pieces of legislation, the NDAA ultimately will start getting drafted again sooner rather than later. It's important to track not only, a House version or a Senate version, but kind of to track both at the same time if there are provisions in one that you're particularly interested or concerned about, and recognizing that ultimately those provisions may end up in a compromised version of the legislation. Moving on. So we have a couple more here as well. We have Section 814, which is essentially making it more difficult if the contracting officer seeks to disregard a commerciality determination, that the contracting officer is going to need to submit a written determination explaining why the product or service is not commercial. And it also, with Section 814, is vesting the commerciality decision with the senior procurement executive of the military department. And it's also going to be applying to subcontractors if the Department of Defense contracting officer previously approved the commerciality at that level. Section 815 is another one with a requirement on the Department of Defense to rely upon historical data of recent prices paid in determining whether the cost of a subcontract purchase order or mod thereof are fair or potentially reasonable. Again, another interesting section in that it was in an original Senate bill. It wasn't in the Senate bill. It ends up in the House bill, and then you see compromise, and it comes in the final piece of legislation that we have. Section 819, requiring the Secretary of Defense to make publicly available the open interface standards for contracts awarded by the Secretary of Defense, unless the service acquisition executive with respect to a specific contract submits to the Secretary a request to not disclose such standards. And this is referring to modular open system approach, which is essentially defined as a technical and business strategy for designing an affordable and adaptable system. And this approach is essentially the Defense Department's preferred method for implementation of open systems. So kind of an interesting one. A lot of these are, I think, can sometimes end up being a little bit more in the weeds, but really important just to be essentially tracking on some of these things, because if they may potentially be relevant to you, it's something that you're kind of going to want to be watching out for. We have Section 882. So Section 882 is going to be requiring the Department of Defense to establish streamlined procedures for production of items that DoD could produce through reverse engineering or re-engineering. And this one's kind of interesting because it's essentially having the Department of Defense develop a process to identify items where we don't have technical data available, or the rights in such technical data do not allow for manufacturing of the item. So ends up being a really interesting tie-in with some intellectual property pieces, which is often a concern for contractors about, are we sufficiently protecting our technical data? And I think an interesting question that comes out of this is what happens now? We're protecting our technical data. Is there now a risk that we're going to see essentially kind of something that we otherwise thought we were protecting, maybe not as protected as we originally thought, if you can now reverse engineer to get to something? Obviously complicated. It's going to require a lot of work for somebody to get to that point, but an interesting piece to watch if you do have a lot of intellectual property or items that you're concerned about what it would look like from a competition standpoint if other parties were starting to kind of get into that space and were able to essentially reverse engineer some of these pieces. To carry this out, what Department of Defense is going to do is they're going to identify items for which technical data isn't available, or maybe where DoD doesn't actually have the right to permit manufacturing of that item. So just something that's going to be interesting to watch, particularly if you have a lot of intellectual property. I think this is an area to kind of be on the lookout for. Also interesting if you're someone who has otherwise not been able to maybe get into a certain area, the ability to actually reverse engineer yourself into that space to be competitive is something that you might want to consider. We have Section 816, amending the approval requirements for prototype other transactions, reducing some of those approval authorities. So kind of an interesting one because we've seen an expanded use of those other transaction authorities and other transaction agreements. And if you're familiar, OTAs essentially provide, I'll call out for contractors, but oftentimes you see a lot of commercial entities entering into the government contract space that otherwise would be hesitant to, because the OTAs are not a contractual document in the same way that your traditional contract is, and that they are not governed in most part by the Federal Acquisition Regulation. So you don't see them governed in the same way by the FAR, DFARS, and associated agency regulations. And so OTAs can be a really interesting space if you're able to get into it, where you do have oftentimes more flexibility. That's the intent with them. And you often have less regulations, which can be, of course, in such a highly regulated space, something that is pretty desirable for contractors. We'll move to the next one. We have a domestic preferences in critical materials. So Congress, of course, continuing a focus on domestic sourcing. We hear it a lot. If you follow the news, if you follow the regulations that are coming out, if you follow legislation, there is consistently a concern about our ability to domestically procure materials that we need, and also to have essentially self-sufficiency for many of the products that the government uses. So Section 847, these are just kind of high-level ones, addresses recycled or reused materials. 846, interestingly, diesel engines for icebreakers, which comes up if you are tracking any of the conflicts about the Arctic Circle region. So there is a lot of interest in icebreakers, if that is your area of interest. Stainless steel flatware and dinnerware. Congress is interested in everything. Specialty metals exception, kind of a curtailment that we've seen there. And then also developing and maintaining a list of all domestic non-availability determinations for items covered by the Berry Amendment. And so what you see here again is a continued focus on domestic production. We have a lot of pieces of legislation and requirements that cover those types of things. Buy America Act, BAA is one of the most common ones that most folks are familiar with, but kind of interesting spaces where we are concerned about where we are getting materials from. And that certainly continues on into this next section of the NDAA, where we have national security related matters. So we have Section 162. These are provisions related to supply chain and technology protection. So 162, domestic and allied supply chain for small unmanned aerial systems. Also 215, incorporation of technology protection features in major systems. And then prohibition on DoD contracts with entities providing semiconductor products to Huawei. As you're seeing Section 853, you may also be recalling to Section 899, which is kind of the original kickoff to this type of concern from Congress, where we were worried about, Congress was worried about the fact that there was potentially, I guess, technologies incorporated in equipment that the government was either using or was using through a contractor or subcontractor that may have had essentially a backdoor ability for a Chinese entity, which potentially could mean the Chinese government, to access that information. And so you see Section 899 is kind of one of the first major changes where you have contractors providing certifications that they don't have those covered technologies in their equipment. This is an expansion in some regards to now concerns about entities providing semiconductor products. Similar company that you see in 899, Huawei, and it also includes subsidiaries of them as well. So there's a list in there that there's kind of a broader list that you see associated with that. Again, supply chains aligning with domestic sourcing requirements, and then also just an emphasis on technology protection. And that technology protection is essentially stemming from this greater concern that exists about China and other, I guess, there's a collection of other countries that most folks are probably familiar who work in this space, usually North Korea and Iran are included in there, Russia as well. You are probably familiar with the Kaspersky provision and prohibition on sourcing from them. So this is just kind of building out on that. And the fact that we continue to see these types of regulations likely indicates that we're going to see more, not less, regulation in that space, and probably more compliance requirements for contractors in that space. So something to be aware of, particularly as you're moving forward, of kind of tracking what, if you have technology, what kind of technology are you using? How old, especially for older technology, is it possible that some of these covered technologies are going to be in there? Kind of things to consider, particularly as we see an increased focus on concerns about China, North Korea, Iran, Russia, all of those kind of entities. Following that same vein, Section 851, prohibiting contractor engagement with lobbyists for Chinese military companies, or any company or its subsidiary that is tied to a covered lobbyist, including a future restriction on any entity that contracts with a lobbyist. And this goes to the DoD's 1260H list. If you're not familiar with the 1260H list, it's about 3 pages, the most current version. So I would suggest that you just give it a skim. It is updated each year at the beginning of the year, so something to keep an eye on to make sure that you're not associating with some of those companies listed on there. And I mentioned the list. Oftentimes it's pretty obvious kind of who some of those parties are because they might have China in their title, but some not so obvious. The example that I pulled from the list is that there is the 360 Security Technology Incorporation Corp. 360 doesn't sound particularly concerning. Or perhaps there's another one as well called CloudWalk Technology Company that's on that list. So just 2 examples of, it may not stand out to you if you are sourcing a product or a part from someone that they are potentially on that list. So just something to keep in mind and to make sure that you are aware of who is on that 1260H list. Again, what all of this relates back to, because we are starting to get low on time, is that there are more and more requirements for contractors to be diligent about who they're working with and who those parties are associated with. And there are essentially more and more burdens for contractors to have that awareness, and subcontractors as well. And so there's a larger concern about China. We repeatedly hear it. It's not likely to change with this administration. With the most recent confirmation hearings, we have heard a continued concern about the influence of China. And so a lot of these restrictions kind of reflect that and our overall national security concerns related to that. Another one in the same vein, I'll skip over this in the interest of time. Industrial base and small business matters. So we have Section 863, expanding a Department of Defense pilot program for streamlining awards for innovative technology. 865, establishing a pilot program. So always interested, new program that you could potentially be able to get involved with to expedite qualification of key technologies critical to weapons programs. And then 874 as well, requiring DoD to create a pilot program to increase access to shared classified commercial infrastructure, and also simplifying the process for small businesses and higher education institutions to apply. So looking here, you see kind of the broad point that you're getting is that DoD is looking for ways to get more parties involved, to increase innovation, and ultimately to increase the ability of the United States to respond, to have the latest and greatest in equipment. And so if you are one of those smaller parties who's looking to get involved, this may be a really good opportunity for you. Cyber-related matters. I apologize that we're kind of flying at this point, but we have a couple of sections that are going to be dealing with cloud computing matters. A lot of these are focused on DoD requirements, so they're not necessarily contractor requirements, but things that the Department of Defense is going to be focusing on and implementing. And so if you're someone who is in the cyberspace or artificial intelligence space, this is something that may be relevant to you. And then we also have, so there's that slide, and I'll kind of, apologies for having to jump through that. I will turn it over because it looks like we have 33 seconds left.
All right, thank you, Morgan. We're gonna have a couple of polls that we're gonna put up now. The first one is just the password. The second password is AID. Sorry about that, capital AID. As a reminder, you want to write these down because that'll be how you receive credit for attending today's session. After this poll, after I take this poll down, we're going to have one final poll, and that's just going to be please rate this session. Morgan or Natalie, if you have anything else you want to add, please feel free to while I put up this final one here.
No, I think that's it from us. Thank you all so much for attending, and hopefully it was helpful. Please feel free to reach out to us, via email or otherwise if you have any follow-up questions.
All right, thank you so much. We have the final poll up now, and that's just please rate this session. Excellent, very good, good or fair. Thank you everyone for joining us. I want to thank the two of you for instructing today's session. I hope you all have a great rest of your day. If you do have any questions about passwords, certificates, anything like that, PCI related, feel free to email me at joshpina@publiccontractinstitute.com. We look forward to seeing you on future sessions. Have a great rest of your day, everyone.
Thanks.
Thanks, everyone.